Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to another podcast. This is episode 89 of Your Tax-Free Life. Today I'm coming to you from the beautiful Madrid, Spain. We're spending a few days here, business and pleasure, obviously by the same token. I have some business clients that are here in Spain, so I'm here visiting with them, and they're in the process of opening other companies in the United States, and I'm going to be handling all of their pension, all of their employee benefits, and so forth. So we're having some meetings here in Madrid, but I'm also doing a little bit of fun with my beautiful bride, who is also here with me and will be here for a couple of weeks. But then again, duty calls, so I'm here again today. And I'm here to give you another podcast because it's important that we do that on a weekly basis, because at the end of the day, information without education always leads to failure. So I make it a point to bring as much education to all of you as I possibly can. Because of the fact that it is October 1st and we only have one quarter left in 2019, something that I do every year. The fourth quarter of every single year is I put out a podcast and I do a seminar and I also do a webinar. Plus I send a lot of information to each and every one of my clients regarding year-end tax tips and year-end tax planning. Now, for most of you that are working with me, you have done most of the tax planning early in the year. Because normally when we do all the tax preparation, both on the individual side of the house and also on the corporate side, I always engage all my clients in tax planning for that given year, and then obviously 2 to 3 years down the road. But some of you, if you happen to be stragglers and you haven't gotten around to doing any type of tax planning, now is the time to do it, because you only have 90 days to try to repair anything that you've done so far in 2019, because when 2020 comes, it's pretty much too late. In 2020, you have to pay the taxes. You can't do tax planning in 2020 for 2019. So hopefully you're going to get some of this information that you can apply right away. As always, if you feel that I can help you in any way, shape, or form, please feel free to reach out to me at 786-766-1042, or you can email me at Bert, B-E-R-T, at gablestaxgroup.com. What's the thought of the day? This is an important one, especially when we're approaching the end of the year. When it comes to tax planning, sometimes you're the windshield, most of the times you're the bug. So unless you do proper tax planning on an annual basis, there's a very high probability that you will be the bug in most of the tax situations that you have prior to filing the taxes. And the reason for that is simple. If you don't prepare and you don't do proper tax planning, then chances are you're not going to be able to use many of the different offsets that you can maximize in order to reduce your tax liability for that given year, especially now for 2019. What are some of the 2019 tax highlights? And I'm just going to run through many of these as we go through, so I don't take a lot of your time and I can just go back and enjoy myself with my family for the rest of the day. But the one thing I always talk about is that there's a major difference. And I do mean a major difference between tax planning and tax preparation. Tax planning involves marginal tax management and tax forward assessment. What does that mean? Well, it means that if you do proper tax planning in 2019, you're going to be able to manage your marginal tax bracket. Remember, tax brackets are divided into two parts. You have your marginal tax bracket, which is the bracket where the last dollar that you report as income falls into. And then you have the effective tax rate, which is the actual rate that you will pay based on all the income at the different brackets, depending on how many levels into those brackets or into that cylinder you went into. So there's a big difference between one and the other. Obviously, that's important to understand. Now, that's tax planning. Tax preparation involves just the gathering of data and determining tax liability. So that's probably what you do, what most of us and most of you have done for many, many years. You just gather your information, send it over to your accountant or to your tax preparer, and then he or she will determine whether you have any tax liabilities for the year or not. Something you definitely don't want to do in 2019 because there are some great opportunities that you need to be able to maximize on. Tax planning involves reduction of effective tax rate. And if we do it the right way and you have enough time on your side of the ledger, then tax planning can actually reduce your effective tax rate to zero, or at least, to the very least, to a single digit number. So you could be in the 24% tax bracket, but your effective tax rate could be 8%. Or it could be 0%, depending on the nomenclature of all that income that you're receiving for that given year. In this case, would be 2019. Now, the 2019 tax brackets and deductions, obviously, we'll talk a little bit about the deductions, exemptions, and credits. What you will find for 2019, which is similar to what you found in 2018, which was the very beginning of the Tax Cuts and Jobs Act, that took effect after President Trump signed it in December of 2017, but did take effect in January 1 of 2018. What you will find similar is that in 2019, same as in 2018, you have higher deductions and lower tax brackets, and that's something that's a win-win because now the vast majority of Americans are actually able to pay less taxes, although they may have made the same amount of money in 2017 as opposed to 2018 or 2019. One of the major issues, and this is important for all of you to realize and understand, is that the Affordable Care Act, also known as Obamacare, had penalties. And these penalties through 2018, you had to pay the penalties if you didn't have health insurance either for the entire year or for a portion of the year. In 2018, though, although the Tax Cuts and Jobs Act took effect as of January 1, 2018, the President's proposal and then the approval by Congress left the Affordable Care Act penalty there for one more year. So 2018 was the last year in which Affordable Care Act penalties were imposed on Americans filing their income taxes. So you don't have to worry about that for 2019. There is no longer a penalty. So the penalties have been waived for 2019 and beyond, at least through the end of the Tax Cuts and Jobs Act. And that brings me to another point. The Tax Cuts and Jobs Act will sunset December 31st, 2025. So any tax planning that you need to do, not only for 2019, but for also years to come, you might as well start doing it now, because if you didn't do any tax planning, you already lost 1 year in 2018, which you would have been able to maximize tax planning opportunities in order to try to achieve a 0% effective tax rate when it comes to your retirement planning. If you do it the right way, you may be able to to actually legally divorce the IRS in retirement, but unless you do proper tax planning, you're never going to be able to do that because your tax preparation software programs do not give you the ability to do such things. Just bear in mind that the Tax Cuts and Jobs Act, again, will sunset December 31st of 2025. So when all of us, and I mean all of us, wake up January 1, 2026, by law, we will find ourselves in a higher tax bracket than we are today in 2019. What are the tax planning rules of engagement? Well, you have to be able to do year-long planning. You have to do income forecast. expense management, and financial statements assessment. So that means that whether you own a business or not, having a cash flow, income statements, and balance sheet would be incredible important for all of us. All of the clients that I do tax planning for, especially those that are small business owners or self-insured or self-employed clients, they all have and they all get from me a cash flow analysis. They get income statements and they also get a balance sheet. So that's important to note as well. It also, as part of the rules of engagement, it also involves doing a 5-year tax forward planning forecast. So because of the fact that we are now in the second year of this Tax Cuts and Jobs Act, anytime I engage clients in doing tax planning, I do a 5-year forecast in order to maximize the internal rate of return on the retirement income that my clients are going to be receiving at some point in time in the future, and also, most important, what you may be doing from a taxable standpoint today. What is the difference between the 2019 and 2020 filing tax brackets? What are some of the things that you may want to do now in the last quarter of 2019? One of the things that you may want to take advantage of is that you may consider shifting certain deductions and income to 2020. So why would you consider shifting any income in 2019 to 2020? Well, that depends. Now, if you don't do any type of tax planning, it's going to be very difficult for you to figure out whether your 2020 income will be larger or smaller than your 2019. But if you do proper tax planning, then it may be suitable for you to start shifting some of that income from the last quarter of 2019 to 2020 in order to minimize your tax liability for 2019. Also, beware that deductions and credits have been phased out. They also have phase-out thresholds that you need to pay attention to. So that is a great way for you to understand, if you're going to be receiving a bonus, or if you're self-employed, or if you own your own company and you're going to be paying a bonus to yourself, well, what's going to be your tax liability, including that bonus in 2019 versus 2020? Does it make sense for you to postpone that bonus until January of 2020 in order to minimize your tax liability for 2019? Another big issue that all of you and all of us need to be aware of are what the medical expense deductions are for 2019 and beyond. For those of you that filed taxes with me in 2018, and for those of you obviously that file your taxes, you may probably know that in 2018 your medical expense deduction was 7.5% of your adjustable gross income. So if your adjustable gross income, let's say, was $100,000, any medical expenses that did not exceed $7,500, you could not take a medical deduction from a business standpoint if you itemized your deductions. For 2019, though, is no longer 7.5%. So that was only in 2018. In 2019, it's actually 10%. So in the same scenario of $100,000 of adjustable gross income, unless your medical expenses exceed $10,000, you're not going to be able to take a deduction on the amount that exceeded those $10,000. In 2018, it was only 7.5%. So depending on medical expenses, 2018 deductions were a lot better than 2019. And by the way, the 10% not only will be for 2019, but so far for 2020 and beyond. Also consider, if you're an employee and you work for a company and they offer you a flexible spending account, consider maximizing your contributions depending on the expenses, medical expenses that you would have in 2020, to start putting more and more money into your flexible spending accounts. And if you're self-employed, then you may be able to create a flexible spending account for you and your family. The property taxes, SALT, state and local taxes, did not change from 2018. As you know, the Tax Cuts and Jobs Act capped the property taxes deduction at $10,000, and they cannot be prepaid. So if you happen to be living in a state where property values are quite high or property taxes are quite high, the maximum deduction that you will have will be $10,000. For most of my clients in Florida, that number is not a major concern. Talking a little bit about the alternative minimum tax, and this is a tax that if you earn income and then you do have a lot of deductions, if your deductions exceed a certain threshold, then the AMT, the alternative minimum tax, will come into play. So it's a great way to take certain deductions away from you and giving you at least a minimum tax liability. For 2019, the exemption increased to $194,800 for those of you that are married and filing jointly. Everyone else is $97,400 for 2019. Now, long-term capital gains, not much has changed there from 2018. As you may recall, the Tax Cuts and Jobs Act created long-term care capital gains at 0, 15, and 20%. Most of the clients that I ask, what do you think long-term capital gains are at? They'll say 20%. For most of you, it's going to be anywhere between 0 and 15%. Always make certain that if you're going to pay taxes, I would rather you pay your taxes as a capital gain as opposed to ordinary income, because the brackets are totally different, and you'll end up paying a lot less on the capital gains side of the house than you would on the ordinary side of the house as well. Consider if you have capital gains, also check your portfolio. See if you have any capital losses. So if you may want to consider loss harvesting, as they call it, but you may want to avoid, you must avoid what is known as a wash sale. That means that if you have a stock in a portfolio that is down 10, 15, 20%, and you have other stocks in the portfolio or other mutual funds that are doing better, you may be able to offset capital gains with capital losses. But be careful, because this has happened to some of my clients. And obviously, when it's time to pay taxes, there's going to be a recapture by the IRS. And what that means is the following. Let's say that you buy a Coca-Cola stock and you sell it today, and you sell it at a capital loss. And then within 20 days, you decide to buy it back because now you have that capital loss, and now you can buy it back because it makes sense for you. Guess what? The wash sale rule will apply to you, and you're not going to be able to take a capital loss. So in order for you to be able to harvest any losses in your portfolio, and you decide to sell that portion of the portfolio where you have harvested the losses, you have to wait at least 30 days in order to buy it back. If you go past 30 days and you buy it back, then you're good to go. You can still claim the capital loss and still own the stock all over again at whatever price it may be at the point in time that you purchase the shares back. If you don't have any capital gains, but you do have capital losses, well, you always have the ability to deduct up to $3,000 in capital losses against your ordinary income taxes. So you can deduct up to $3,000 in capital losses, and you can plug that in against your ordinary income, and at least it will help you deduct that. Now, you can deduct capital losses up to 100% of capital gains, but when it comes to ordinary income, you do have that maximum of $3,000. You also may want to avoid or partially sell profitable investments depending on the tax forward planning calculation. So if you have stocks that are doing well or mutual funds that are doing well for 2019 and you want to minimize your tax liability, well, it makes no sense for you to be able for you to sell those shares of stocks or mutual funds in 2019, because you're going to harvest that capital gain, which will have to be added on to your calculations for tax purposes when you file your taxes in 2020. So those are things that are critical to understand. Also remember that, as I always communicate to all of you, make sure you've done proper due diligence and you understand that you have a balance between your taxable, your tax deferred, and your tax-free bucket. What is your taxable bucket? Well, those are your savings accounts, your CDs, and your mutual funds. Your tax-deferred bucket would be your qualified plans, your IRAs, your 401ks, your 403bs, your pension plans. And then obviously, last but not least, your tax-free bucket would be your Roth IRAs, your Roth 401ks, your municipal bonds, and your 7702 plans, which are cash value life insurance contracts. So make sure you do have a proper balance. Now, what should that balance be? Well, I would imagine on the taxable bucket, you want to have at least 6 months of fixed and variable expenses. If you say, Bert, maybe I want to keep a little bit more in there because I'm thinking about picking up a piece of property and you want to do so, then you're welcome to keep a little bit more. But remember, because it is those assets are located in the taxable bucket, then you will be receiving a 1099 at the end of the year, which you will have to report for tax purposes. Your tax-deferred bucket, that's where your 401ks, IRAs, and 403bs and your pensions reside. If you're putting money away into a 401k, into a corporate plan, contribute to the corporate match, but not more than 7%. So if they're matching you dollar for dollar up to 3%, and then 50 cents on the dollar up to for another 2%. So if you put in 5, they'll match 4. Well, you might as well contribute up to the 5% realm because of the fact that you're going to get a dollar for dollar match and then 50 cents on the dollar. If you want to contribute a little bit more, then I would argue, go ahead and contribute another 2% to a maximum of 7, but never more than 7%. Because if you have too much money in the tax-deferred bucket at retirement, then you have just created all kinds of taxable issues that we've talked about in the past that are going to come to bear a nemesis and become a nemesis to you and your family until the day you die. So be careful about how much money you put into your tax-deferred bucket. For 2019, your maximum contributions to your 401k was $19,000. If you were age 50 or older, you would also be able to make a $6,000 catch-up to a maximum of $25,000. If in 2019 you wanted to make a contribution to an IRA, the maximum that you could contribute this year would be $6,000. And then again, if you were age 50 or older, you could contribute an additional $1,000 for a total of $7,000. Although the 2020 numbers have not come out yet, I'm pretty certain that for 2019, these contribution limits are going to go up a little bit. So for 2020, instead of 19,000 contributions to your 401k would be 19,500, and then obviously your 6,000 catch-up contribution would go up to 6,500. So that's something that would be 26,000 in total contributions. If you want to contribute in 2020 to an IRA, then it would go from 6,000 in 2019 to 6,500. And the $1,000 catch-up would stay at that, so it would be a total of 7,500 as opposed to 7,000 in 2019. The tax-free bucket, listen, at the end of the day, whatever doesn't fit in the taxable bucket or the tax-deferred bucket should go in the tax-free bucket. You can put as much money as you want into the tax-free bucket because once you do so, you have actually divorced the IRS in retirement. And it doesn't matter how big that bucket gets, your income is going to be totally tax-free for the rest of your life. So you want to make maximum contributions to your Roth IRAs and your Roth 401ks. You may want to make maximum disposable income to a 7702 plan because 7702 plans, which are cash value life insurance plans, do not have a maximum that you can put in. It's just what you can qualify for. And also, by having a properly structured 7702 plan, you have the ability to reduce the exposure to the fatal 4 in retirement, which is the risk of dying too soon, living too long, living with a disability, or living with eroding factors. Many of my clients right now are using 7702 plans not only to max out all the contributions in order to receive tax-free income in retirement, but they also want to protect themselves and their families in case of a long-term care issue or disability, because the 7702 plan has, they have riders, some of them do have riders that provide for critical illness and or long-term care benefits, which is one of the major issues that all of us are going to have to deal with in retirement, because we're living a lot longer today than ever before. So if you live long enough, everything is going to happen to us anyways, so you might as well have full protection of that. Retirement distribution planning for 2019. This is a very important one. If you're turning 70 and a half in 2019, your required minimum distributions have to be taken no later than April 1st of 2020, and that would be for the 2019 year. So if you turn 70 and a half in 2019, you can take your required minimum distribution in 2019, or at the very least, you can delay them until April 1st of 2020. The big question is, and this is where tax planning comes into play, does it make sense for you to take your RMD in 2019 versus 2020? Well, the answer is it depends. It depends what your income is going to be in 2020 compared to 2019. Because if you delay taking your 2019 required minimum distribution to 2020, then in 2020 you're going to have to take two distributions. You will have to take the 2019 distribution no later than April 1st of 2020, and then your 2020 distribution must be taken once again no later than December 31st of that same year. So depending on your tax liability, it may be feasible for you to delay the 2019 to 2020, but otherwise it may be more beneficial for you to do it in 2019. So that's something that tax forward planning calculations can help you determine which one or whether it makes sense to exercise it now or to wait until 2020. Remember that RMDs apply to qualified plans, 401ks, and IRAs independently of each other. So, if you have $100,000 in a 401k and $100,000 in an IRA, you must take a required minimum distribution out of your 401k, and you must take a required minimum distribution out of your IRA. Also remember that if you happen to have a Roth 401k, you will, in 2019, you will have a required minimum distribution. The only way to avoid that distribution is prior to reaching the age of 70 and a half, that you would convert or do a rollover of your 401k Roth to a Roth IRA. And if you do so, then your Roth IRA has no required minimum distributions, and you can allow that money to continue to grow on a tax-free basis, and you're never obligated to take it. So therefore, by putting as much money as you possibly can into the Roth IRA, you are now controlling the distribution of your retirement assets as opposed to the IRS. Also remember that for those of you, and many of my clients have multiple IRAs in multiple institutions, beware that your RMDs are based, for instance, if you turn 70 and a half in 2019, your required minimum distribution will be based on the account values that you have for your 401ks and IRAs as of December 31st of 2018. Let me repeat that. Your RMD is based on the previous year, end of year account values. So if you had $100,000 in IRAs as of 12/31/2018 and you turned 70 and a half in 2019, then that 2019 RMD will be based on the value that you had in the 2018 account. And the same will apply for 401ks. Now, but then again, if you do have multiple IRAs, then you don't have to take, if you have, let's say, 5 separate IRAs, you don't have to take an RMD from each and every one of those IRAs. You can lump sum all of the IRAs since they are like-kind accounts, and you can take it from whichever account you have. So if you have, let's say, $100,000 in total IRAs, and you have 4 CDs, with $25,000 each, then you can pick from one CD and take the RMD for the entire $100,000 out of that one CD or that stock or that mutual fund, and you don't have to take them out of each and every one of the other ones. So if the accounts are like kind in nature, then you can choose which account to take the RMD from. So if you have different types of investments in IRAs, then I would recommend you understand how well those accounts are doing, because it may be more suitable to take those required minimum distributions from an account that is outperforming as opposed to an account that may be underperforming. Qualified conversions, obviously, you always have the ability, especially now under the new tax law, and this is something that I spend a lot of time with my clients. You can go from 401ks and traditional IRAs to Roth. Be careful when you do that, because obviously in order for you to go into the tax-free bucket, which would include your Roth IRAs, then you have to be able to pay the ticket. And to pay the ticket is to pay the taxes today. So if you have $100,000 in an IRA and you want to move $10,000 out of that $100,000 to a Roth, and you got to be prepared to pay the taxes based on your tax bracket now on those $10,000. But tax planning would give you the ability, how much can you move comfortably from one year to the next to eventually get to a point where you have no tax liability, and all of your money, if you do it the right way, would be totally tax-free in the future, regardless of where tax liabilities would end up at some point in time. Obviously, based on all the information that I have given you for the last couple of years, there's a very high probability that taxes are going to have to double in our country, or our country's going to go bankrupt. Now, for those of you that are in retirement, provisional income calculations. Provisional income calculations actually determines what percentage of your Social Security benefits will be taxed in retirement. And the way that those calculations are done, and I do it for my clients every single year, and this is where tax planning comes into play, the way that I do it is you have to take a look, take into consideration 1/2 of the Social Security benefit that you would be receiving in 2019 if you're already receiving benefits. To that, you have to add your ordinary income, which would include any distributions from your IRAs or for traditional IRAs and traditional 401ks, any part-time work or full-time work that you may be doing. So you have to add that to the provisional income calculation. You would also have to add capital gains, and you would also have to add the income that you receive from municipal bonds. Yes, although municipal bonds are received federal income tax-free, the income that you receive gets added on to the provisional income calculation to determine what percentage of your Social Security benefits will be taxed in retirement. And yes, whether you understand this or whether you knew this or not, there's a very high probability that for the vast majority of listeners that I have on my podcast, if you don't do proper tax planning, up to 85 cents out of every dollar coming out of Social Security benefits will be taxable. Now, it could be zero, or in worst case scenario, it could be 85%. It's up to you. It's like the Midas commercial. Either you're going to pay it now or you pay it later. If you do proper tax planning, you would be able to reduce those tax liabilities significantly, or at least try to do the very best that you could along those lines. Obviously, consider tax forward planning to manage your current and or future year taxation. Now, one of the things that I want to talk a little bit more about is, how to create a customized tax planning blueprint, and the benefits of creating a tax planning blueprint. Number one, it's going to help you reduce and or eliminate your taxes in retirement. Number two, is going to help you eliminate the torpedo tax. Most of the time. So the torpedo tax is that additional tax that you're going to have to pay on your Social Security benefits if you don't do proper tax planning. It's also going to allow you to maintain the proper balance between your taxable bucket, your tax-deferred bucket, and your tax-free bucket. And then if you do it the right way, it will also help you reduce and or eliminate the fatal four in retirement that we have talked about: dying too soon, living too long, living with a disability, and or living with eroding factors. Now, what if you're self-employed? What if you happen to be a small business owner? What are some of the tax strategies that you may want to do between now and the end of the year in order to minimize those tax liabilities in 2019? And again, proper tax planning is paramount, because you don't want to do a really good job in 2019 to end up having to pay double in taxes in 2020 because you pushed everything away 1 year down the line. So what are some of the things that you can do? Well, one, you can purchase and or lease equipment and supplies prior to the end of the year. So if you need to, purchase equipment, or you need to lease a piece of equipment, or you need to purchase supplies, depending on your tax liability, may be more suitable for you to do it in 2019 and harvest those additional expenses. If necessary, you may want to make payroll tax deposits in 2019 instead of January 15th of 2020. So you know that you have to pay estimated taxes on a quarterly basis, and then the last tax for the last quarter is paid in January of 2020. You can pay those in 2019, and then obviously take those deductions as well. You can also, if you're a business owner, you can avoid collecting account receivables or invoices until the first quarter of 2020. Now, obviously, you got to make certain that you're dealing with the right type of companies and the right type of people, because at the end of the day, if they're due and someone wants to pay you, then you got to consider taking the money now. But if you can avoid taking those additional receivables in 2019, while by the same token also doing all the purchases and lease equipment and supplies prior to the end of the year, then you're increasing your expenses and you're reducing your revenues. Also, passive losses are limited or deductible in 2019 as well. Also, you need to verify your net operating losses for 2019 so you can determine your carry back and carry forward. Make sure you have a conversation with your accountant. Don't start having those conversations in January or February of 2020 for 2019. Do it now. Take an hour and a half, make an appointment with your accountant, take all the stuff to him or her, and make certain that you can start doing tax planning between now and the end of the year. Obviously, if you have any issues or concerns, feel free to reach out to me, and I'll help you along those lines. Charitable deductions. Try to make as many deductions as you possibly can for charitable organizations, especially, obviously, if you itemize your deductions on an annual basis. Also, if you're self-employed or business owner, you may want to consider having an employee benefits program. Now, there's one here that I'm going to mention that I haven't talked about before that would be very, very important for most of you. And the question is, well, are you self-employed? Do you have children? If that's the case, why don't you put them to work? Because if you have a really good company, like I did for many years, obviously, and I have my daughters working with me when they were teenagers, and I would pay them for the work. Number one, you're educating your kids as to the value of $1, but number two, you're going to be able to do a number of things from a taxable perspective that you would not be able to do otherwise. Now, if you're self-employed and you're not incorporated, if you're self-employed and you have children under the age of 18, in 2019, you can actually pay them or pay him or her up to $12,200 in salary, and they will pay no federal income taxes. And the reason why they would not pay any federal income taxes is because that $12,200 in salaries that you're paying your children or your child, it gets offset by the standard deduction. The other thing that you can do for a child under the age of 18, if you want them to start contributing to a savings account, let's say you want to help them. Let me get a little bit of water. Let's say that you want to help them start their own retirement plan early on. Well, not only can you pay them the $12,200, you can also pay them an additional $6,000 So you can pay them now up to $18,200, and again, no federal income taxes because the $12,200 would be offset by the standard deductions, and then the IRA contribution, the traditional IRA contribution, is a tax deduction against the income. So therefore, they would have a tax liability of 0 for 2019. Now, the other thing that is critical for self-employed individual to understand is that because you're paying them a salary, that's also reducing your revenues or increasing your expenses. So you're able to kill multiple birds in one shot. Instead of just giving money to your kids, put them to work, pay them a salary, take it as a deduction, not an after-tax contribution. Take it as a deduction on your books as a salary expense, and on top of that, your children are going to be able to maximize that income at no expense or tax liability to them. And this is another big one if you happen to be self-employed. If your children are under the age of 18, you do not have to contribute to FICA. Therefore, that 7.65% that your children would have had to contribute, if they're under the age of 18, they don't have to contribute to Social Security and Medicare. And you, as the employer, that otherwise you would have to match that 7.65% to get it to a total of 15.3. You don't even have to contribute that match of 7.65. So that means that you just saved yourself a lot of money as a self-employed individual. You were able to provide a lot of money to your children. And I'm talking about one child. What if you happen to have 2 or 3 kids? You know, that can add up. That could be $30,000, $35,000, $40,000 that you can have in additional expenses on your company while really helping your kids get better and understand the fundamentals of money, savings, and investments. They're also working in the company, so they're learning how to work. And by the same token, it's not costing you anything from that perspective because you're taking a tax deduction. It's not costing your kids anything because they're also taking a tax deduction, and there's no Social Security taxation done. Please remember that 7.65% of FICA, 6.20% of that goes toward Social Security. So when you combine the employee and the employer, would be 12.4%, and then 1.45% goes toward Medicare, and that would be obviously 1.45 on the other side as well. So that's 2.90 when you add the 12.4 and the 2.90, then you get to the 15.3. So those are things that are very, very important to understand. So if you are self-employed and you haven't done this, well, put your kids to work between now and the end of the year. Finally, I'm just going to give you the update on the standard deductions versus itemized deductions. By the way, for 2018, the vast majority of Americans actually took the standard deduction as opposed to itemizing. In 2018, only about 20 to 25% of Americans actually itemized. For 2019, it's going to be probably even less. Why? Because in 2019, if you happen to be married filing jointly, your standard deduction just went from $24,000 to $24,400. If you're single in 2019, your standard deduction went from $12,000 to $12,200. If you are head of household, then your 2019 standard deduction is at $18,350. And if you happen to be age 65 or older or blind, then you got an additional deduction of $1,300. Bear in mind that according to the IRS, only about 20% to 1/4 of Americans will itemize in 2019 through 2025. Now 2026 is going to be a different ballgame altogether because the standard deductions go back down. plus the tax brackets get increased. So hopefully this has been beneficial and educational to all of you. Sorry we took a little bit more time. I'm in Madrid. I'm getting ready to go out and spend a little bit of time with my wife. We're going to go have some drinks later on this afternoon. We're actually 6 hours ahead of most of you and on the East Coast of the United States. And always remember that if you want to reach out to me, please feel free to call me at 786-766-1042, especially if you want to do some tax planning for 2019, because we're running out of time, and I normally close my offices on December 15th until January 5th. Also, you feel free to send me an email at Bert, B-E-R-T, at gablestaxgroup.com. And as I always say to all of you, my goal, even from Madrid, Spain, is to kind of help each and every one of you to change the way that you look at things and that you see things, because when you change the way that you see things, the things that you see change. So again, I hope all of you are having a great time. We'll talk again next week. I will still be in Madrid, but I'll do the podcast from here as well. So have a great time. Have a great rest of your week, and talk to you soon. Take care. Bye-bye.